Once I got into real estate, just understanding the sort of the broad breadth of it, it incorporates a number of different professions, from the developer to the contractor to the property manager to a broker to a lawyer. I mean, there are a whole lot of different professions that it encompasses. But what keeps me here is the broad application to actually help and make differences in people's lives and in communities. And it really isn't that difficult. At the end of the day, you don't have to be a rocket scientist to really understand and do well in real estate. You just have to be persistent and stay with it. I ended up showing up to college not knowing what an interest rate was. I approached accounting the same way, couldn't understand it for the life of me. Just didn't make any sense to me. And I had to go over it again and again and again until it started to make sense. So for those folks who are struggling earlier on, I would say, one, stick with it. I would say the second piece is know you're not alone, because while it's not overly difficult stuff, boy, it's not easy if you've never been exposed to it. Some of it's just a matter of learning the vocabulary. The third thing I would say is reach out to those individuals who do understand it and perhaps can explain it in more layman's terms. Because at the end of the day, a lot of it's just common sense. So I would say muscle through it, understand it, and seek help when you need it. That's what I would do.
Investing in real estate is capital intensive, meaning it takes a lot of money. Normally, real estate investment depends upon capital or equity, which just means cash, and also loans, which are just debts, also known as leverage. Together, the debt and equity put into a deal with a particular structure to it is called the capital stack. There are lots of places to get equity and debt, but investors and lenders willing to provide it all expect to make a profit. If people and companies who lend money or give cash to get a property weren't going to make money, it wouldn't make sense for them to invest. A big part of real estate investment is understanding how much a property is worth. Valuation, or how much a property is worth, is more than just the price tag someone puts on it. What matters is how much someone else would pay for it. In commercial real estate, that has a lot to do with how much income it could generate now and in the future. This is a creative business. If you can think of a better or more efficient way to use a property, you can generate more revenue from it. And if you can generate more revenue, you can increase the value of the property.
So what is underwriting? So underwriting starts with a kind of a broad-based look at a marketplace. You go, would I want to deploy my debt or my equity in this marketplace? So when we start to underwrite, we start to look at what's the market. And the market's going to start with a city or an area. And then it's going to narrow a little bit to the neighborhood, the locality with which the property resides in. And then you're going to underwrite and start looking at the subject property. What's its site? What's the structure on it? And what are the tenants? And what's the property? So when we start talking about underwriting, we look at each one of those qualitative factors to determine whether or not this property is likely to be a success. So it's the qualitative piece that's really quite important, but then we also use those metrics of loan to value, debt coverage ratio for the lender, and return on equity for the equity investor. That summarizes some of that. So the underwriter is really the analyst who looks at these deals and says, how risky is that cash flow, and what is the cash flow likely to be, and what's its upside versus its downside. So we really have to start looking at how do we manage the risk on the downside and amplify the returns on the upside. Let's start looking at good and bad examples of property underwriting. And as we led into the Great Recession in years of 2005, 6, and 7, the underwriting got rather generous. And so when we started looking at property, we started presuming greater income streams that were different from what was truly going to happen. We also got riskier. We put more debt on deals. And that created greater risk for the developers. And when we start looking at the Great Recession of 2008, 9, and 10, it was largely created by commercial real estate investment and residential real estate investment by using too much leverage and poor underwriting of commercial real estate and residential real estate.
Underwriting is the process that lenders or other financial service providers and purchasers go through to value a property to decide whether investment in the property makes sense. It's a very important process because if it's not done in a disciplined way, then people can borrow more than they can repay or invest equity without adequate reason to expect a good return on their investment. Undisciplined underwriting can have serious consequences to financial markets, neighborhoods, and families. When underwriting is done well, projects work, investors make money, and tenants enjoy the benefits of a well-financed and managed building or project.
So when we look at a property income stream or the property income pro forma, we use it in a variety of ways. One way the lender looks at that is they use it to put forth a series of metrics based on property cash flow and the cash flow adequacy to service debt, one, and two, the value of that cash flow income stream, what we call the loan to value, how the value of that property is relative to the loan amount. Those are the two primary lender ratios that we use in metrics. And when we underwrite properties, we don't just take the income stream as given. We go out into the marketplace and we get comparable properties. We find out what are the other properties that are similar to ours renting for in the marketplace, one. Two, we get also comparable sales. And so the comparable sales, what are other properties selling for and what cap rates do they have? So both those start to give us some background on what other properties transacted at recently, one, and two, what are rents of similar properties getting in the marketplace. We want to trust what a developer or what someone's providing us with, but we want to verify that as well.
Lenders often use the pro forma as a tool for valuing real estate. From the lender's point of view, the most important factors when valuing real estate are whether the property has enough cash coming in every month to pay the debt and the interest on the debt. Debt is required to be paid first, so equity investors have to wait for any returns until debt and interest is paid. The other question of importance to a lender is the ratio of the loan to the value. This is because the lender wants to know that there's enough equity or cash money invested so that they can get their money back even if the value of the property decreases. Equity investors expect to make money. They give cash to finance a project, and they expect to receive more cash than they gave in return. Right now, 5 or 6% annually is usually considered to be a reasonable return, also called a cap rate, meaning that for every dollar an equity participant invests, she gets back $1.06 each year. It's important to equity investors to know how much money they will make over the period of their investment.
A cap rate is the cash flow return on the property. So it would be the income from the property, the NOI, divided by the value of the property. And that gives you the first year cash flow return. It is a market determined number, so it's a little bit like a price earnings ratio flipped around. So price earnings ratio used to value stocks. Here we use that same metric or similar metric to value commercial real estate. But so how do we value property? We value property by taking the income stream from the income pro forma, the net operating income, and divide it by an expected rate of return, which we call the cap rate. That provides us with a property value. So let's go through an example of how a cap rate works for us. So, and let's use some really simple numbers. So let's say you've got a property that has an income stream of $10,000. And let's say you invest $100,000 into that investment. $10,000 divided by $100,000 gives you a 10% return or 10% cap rate on that property. We're filming today in Washington, D.C. Let's use Washington, D.C. as an example. In Washington, D.C., we had this corridor on Massachusetts Avenue and New York Avenue, which is kind of in the northwest side of the city, but it was in an economically challenged portion of the city. And what happened was it is completely transformed over the last decade. So first off, the municipality, so it goes to the importance of the local government, said, we are going to invest in new infrastructure, new roads, and make this a great place to go. And they may even have provided some subsidies for the first developers to get in there. So they kind of they seed that area. And then from there, it becomes a place where that's now safe and desirable and has a set of amenities. So think about a person who's renting an apartment. You go back 10 or 15 years into that, what they call NOMA, north of Massachusetts Avenue area, and it really lacked a grocery store, it lacked other types of retail, it probably lacked safety. It had a whole series of things that were lacking instead of amenities. And what the municipality needs to do is create a set of amenities that are desirable, and that's what they often subsidize to bring in other development. And that's how locations are created.
Well, housing affordability is that are paying more than half of their incomes on their housing, and whether that's rental housing, owned housing, whatever it is, it's a problem if folks are paying that much of their income. We're seeing household growth happening at a rate that is outpacing home production today, and so we're only going to see that problem get worse unless we can unlock some production locally and particularly enable some production for moderate and lower income working households who don't have a lot of choices today. There are a variety of ways to address the challenge of housing affordability, and we're really trying to address it across the income spectrum. So at the very low income level, for folks at the very bottom of the income scale, it really has to happen with some public subsidy. It's very difficult to make those numbers work without adding some subsidy. But one of the things we'd really like to see at the center is local policy changing in ways and local development practices changing in ways that can reduce the overall cost of development and allow development, residential development, to serve lower income populations. They just can't make the projects pencil out right now at rents that folks at the affordable or workforce housing level can afford. And so we'd like to see some changes around policy and regulatory structure so that developers who are interested in serving this group where there is a ton of demand are able to do that. And frankly, it's just very, very difficult to do, particularly in the higher cost coastal cities. Housing is really a system, and it's difficult to talk about affordable, so-called affordable housing or so-called workforce housing because there are lots of variables that go into that mix. And the truth is that whatever your income level, you shouldn't have to spend more than about a third of your income on your housing. And that requires a variety of sizes and housing products in order to meet that need. Missing middle as a term has taken on a life of its own in housing the last couple of years. I think originally it referred to housing typologies, so things that are larger than single-family dwellings, but smaller than your very large multifamily developments. And we just haven't seen the kind of production of that housing that's affordable to moderate and kind of the higher end of the lower income scale. And that causes a couple of problems because housing is a system. And so folks who came in at a lower level and now would be able to move into a little bit larger or more expensive housing don't have that housing available to them because the folks who are living there now in turn don't have housing that they can move up to that's affordable. And so that puts more pressure at the bottom because you still have folks who are coming in, people who are just beginning to work, households that are just beginning to form, and you need that product there for them at the very low and at the low income scale. But the only way you do that is provide opportunities for people to move up over time. And that's why you can't just focus on what's been known as affordable housing or what's been known as workforce housing. It's a system-wide problem, and really building to that missing middle is going to be a key solution to the problem. You really need good housing for the overall infrastructure of a community to work, and certainly for the social infrastructure to work. So if we can see an understanding of that in 10 years that's enabling cities to move forward and do what they need to do to allow the housing that they need to be built, that'll be a much improved world from where I sit.
Development depends upon partnerships, vision, and creativity. Resourceful analysts can figure out the small differences in deals that will make a big difference in the long run. So, for example, if a property is in a neighborhood where rents are low, but art galleries and coffee shops are popping up nearby, that neighborhood may be improving or transitioning. That might mean higher rents, and higher rents will mean higher ROI. There might be some improvements that could be made to the building that would increase rents. These types of observations could lead to moves that lead to more profit for you and your company, and a better experience for tenants. You wouldn't invest in a property without a thoughtful plan. And as a lender, you wouldn't want to provide a loan without doing this work. If a developer gives you these numbers, it would be wise to check for yourself. Even though real estate is an investment, it's also a real, tangible thing. It's the buildings, the offices, the restaurants, the parks, the playgrounds that make our world better and connect us to one another. Development is important because good development has the ability to change communities for the better.